But with capitalisation at the correct level, write-downs at the robust and honest level, internal restructuring of the bank's management teams to carry out the recovery's work over the next 4 to 5 years, and above all, brand new boards for the banks immediately. No 2-year stay or 1-year stay of execution on those that might have been a member of the board before 2008, September 2008, for, as it's held out, continuity purposes. The very thought of that is absurd. The fact that anybody on the board of a bank that allowed the abandonment of fractional reserving, which we explained at the outset of this interview, anybody who was on a board and didn't shout stop with red flags to that abandonment of principle has no business on the board of a bank. No business whatsoever. And it is comforting and reassuring to see that following the G20 meeting, and even prior to it, the American regulatory authorities and the American professional bodies are coming to a consensus that the capitalization level for a bank licensed to take deposits should be in the order of 8% to 10%. And that coincides with what was the tried and tested historical level of fractional reserving, because capitalization of a bank is a form really of long-term fractional reserving. So it's up to us now that we see things with better analytical building blocks of what the picture is made up of, to get down to this challenge, and we're all well up for it and well able for it, of writing down the bad assets to the levels that they should be written down, determining by that exercise the amount of immediate capital required. The indicative figures are, the scale figures are about 31 billion. That will hold the level of capital that's in the banks at the moment at about 26, 27 billion. That includes what the government has already injected in, a level of 10.8 billion. With new boards understanding the responsibilities of banking and tasked to report to an oversight, governance, call it State Investment Board, because the State Investment Board would acquire that 31 billion of additional money, acquire it on the market, acquire it from international financiers and other governments. It's because the story is now one that's clear, that makes sense, that can be committed to, that has a time frame, because the results of this injection of capital, rehabilitation of the banks, their boards, their managements, the collections, the recoveries in the firewall divisions, that can all take traction and create its own momentum, its success momentum. There's medals to be won in this. This is like a financial Dunkirk if well organised. It will make sense, it will be properly resourced, and it will motivate people involved to greater achievement. And as the story becomes recorded on the quarterly reports to the Oversight Investment Board, then you have track record. The track record will show an upswing, one of success and growth, and that then becomes maintainable, that level of success and profit. And there's no reason not to believe that the banking sector could generate annual profits on a properly stabilised and capitalised basis of somewhere between 6 and 7 billion euro a year, on the basis of having loan books to customers that have been cleansed and recovered in the order of maybe 360 billion or 370 billion. That shows a return on those assets of about net return of about 1.75%, which is a very achievable level of return. So if you take a 6.5 billion annual maintainable net profits for the banking sector into the future and multiply that by a price earnings capitalization figure of 6 or 7 times, you'll have somewhere between 42 and 45.5 billion of capitalization. And at that point in 5 or 6 years' time, those entities, those rehabilitated banks, can be sold on the markets or sold as trade sales to bigger banks from Europe or from the United States that might wish to take them over. And in that way, the state realizes its investment, its initial 10.8 billion, and its additional 31 billion to cover the write-downs that we just talked about. Minus, of course, the bond holders in Anglo of about 3.7 billion. So in total, there's a state investment at a level of about 37 or 38 billion, all told. And we can see that at the end of the period of 5 or 6 years, the capitalization of those healthier, stronger, capitalized and rehabilitated banks more than covers that level. And of course, the state at that stage will probably be owning in the order of about 85%. They're the sort of details that can be worked out, but the overall structure, the scale of what needs to be done, and what's entailed in what needs to be done, I think is told in that story. I hope it covers the ground adequately.